Hey guys, this is Max. I wanted to go over last week's trading results for the QQQY. I made this chart for people that are visual learners. I drew these green profit boxes on the NDX chart. You can see QQQY had a great week, winning 4 out of 5 times, plus today. I also put the amount of money the fund earned each day right above the day. The way these boxes work is if the market closes inside the box, the fund won money that day. The trade was a winner. The top line is the max profit line, and it's also the strike price. The fund, or if you own the fund, you want the market to close right at the top line or above. That's your max profit. The bottom line is the break-even line. If it closes under that line, you're a loser. If you're the person that bought this option from the fund, they want it to close under that line. We want it to close inside the green box. You can see selling options on the NASDAQ has a huge edge because you start in the money as soon as you sell it. If the market goes nowhere, you win. If the market goes up a little bit, you win. If the market goes down a little bit, you win or break even. This illustrates pretty well how sellers win 2 out of 3 times in options. Covered call funds and put-right funds have been around for years, and they don't decay. Maybe it would be better not to think about this investment as a stock or an ETF. It's more like you're a partner in an option trading company. They call them dividends, but in actuality, they're trading profits. I like these Defiance funds because it's like you're hiring the best fund manager in the world premier fund managers to trade options for you. I'm sure they aren't the best in the world, but I think they're pretty good. SPX and NDX killed it this week. QQQY and JEPY also killed it. So let's talk underperformance. So if you look at the Friday close from the week before to the Friday close this week, the NASDAQ or the triple Qs were up 2%. The QQQYs were only up 1.97%. That happens a lot of weeks, and that's why you get underperformance over long enough periods of time. This isn't decay, though, or erosion. It's just underperformance. This is a very typical week for the market where you have at least 2 choppy sideways days. In the summer, lots of times it's 3 or 4 choppy sideways days. These fund managers have quantitative models. The average day the market goes nowhere. These strategies monetize days that go sideways. This is a mean reversion strategy because you're selling volatility, and volatility itself is mean reverting. In other words, when it spikes, it's up for a couple of days, then it comes back down usually. These guys aren't trying to beat the market by timing the ups and downs of the market. You can see after the big up day on Monday, Tuesday and Wednesday and Thursday, the market mean reverted, pulled back, and went nowhere, giving the traders 3 nice days of trading profits. They know over time the market will go sideways more often than not, and these profits will accumulate and help offset the days when the fund goes down, or when the NASDAQ goes down and the fund loses money. A lot of people in the comments say, okay, so it goes up and I'm capped, and then it goes down, but I take the full loss, so it's going to go to 0. What am I missing? What they're missing is it doesn't just go up and down. It also goes sideways a lot. Let's say it goes up one day, down one day, and then sideways 3 days in the average week. And you can see how the profits accumulate. Math and the law of averages is what makes this strategy work. This is actually a super boring, super safe strategy. The short put strategy is such a sure thing. Insurance companies have been doing it forever. Insurance companies aren't going to do something they don't make a sure profit at. They have guys working for them called actuaries, and that's what actuaries do, is they work odds out on everything imaginable. This is a very safe way to make money. People do not realize how safe this strategy is. The backtest shows you selling an option every day has a huge edge. The really amazing thing about this strategy is if you look at this backtest over 17 years, the best month in the history of the backtest was March 2020, when the NASDAQ would drop 40% in 3 weeks. You're writing puts on this strategy, and writing puts is a bullish strategy, and you're exposed to the full downside, and the market dropped 40%, so you would have thought you would have got killed in March of 2020, right? Well, not actually. Actually, it was your best month. If 2020 isn't going to blow up this strategy, nothing will. The strategy does collect bigger premiums in high volatility, so selling puts is bullish. It does give you some buffer on the downside. Check out my new indicator, the Hive and the R-Hive. The best stocks in the YieldMax universe to buy, according to the R-Hive, which is a risk-return metric, are TSLY and GOOY. The R-Hive measures how much return you can get per unit of risk. The most volatile stocks, according to the Hive, are InFly and OARC. I'll post the R-Hive and the Hive again tomorrow, and I'll also post the green profit boxes tomorrow. Thanks very much. I appreciate it. Have a good evening.